Hi friends, welcome back. This is Daksh here. Today we will see if negative interest rates can solve the economic stress caused by COVID-19. I know many people have trouble getting their heads around the concept of negative interest rates and how does it work in the actual world. Also, why some countries came up with this concept of negative interest rates in the first place. I will try to cover all this in this video, so be with me till the end. During the financial crisis of 2008-2009, central banks decided to cut interest rate levels as close to zero as possible, hoping that this would encourage businesses to borrow more, which would then stimulate the economy. We all thought that interest rates at 0% was the lowest possible level, but still the economies were struggling. Thus, central banks came up with this unconventional tool of negative interest rates. Now let us try to understand the concept of negative interest rates from a very simple example. Assume that a customer comes to deposit 1000 euros in his XYZ bank. Under central bank's regulations, the XYZ bank has to keep a certain percentage of deposits with central bank as reserves. Say with 10% reserve requirement, XYZ bank deposits 100 euros with central bank and can lend the remaining 900 euros to businesses. Now during stress times, XYZ bank may choose to hold on more reserves with central bank, say additional 200 euros from that 900 euros, which leaves only 700 euros for lending. To prevent this, with a negative interest rate of say minus 0.4%, the central bank can charge a penalty of 0.8 euros, which is nothing but minus 0.4% multiplied by 200 euros on these excess reserves, thus forcing banks to keep reserves at bare minimum levels and lend the remaining amount. Currently, central banks of three countries have negative interest rate policy. First, Switzerland with minus 0.75% interest rate, Denmark with minus 0.6% interest rate, and Japan with minus 0.1% interest rate. If we look closer at these countries and try to assess the impact of negative interest rate on these economies, we see many arguments against the use of negative interest rates which were intended to stimulate the economic growth. The first argument is, if banks try to pass on their negative interest rates to public, meaning to charge public for their deposits, the public has many options to evade the penalties by not depositing that money, instead keeping it in the form of cash or gold. Or they can split the large deposits into multiple accounts of small deposits to avoid that penalty. The second argument is that negative interest rates can squeeze the bank's profits. With low interest rates, banks will earn lower on the loan advances. Their cost also goes up due to penalties charged on the excess reserves. Also, as seen in argument 1, it is clearly difficult for banks to pass on that cost of negative interest rates to the depositors. To counter COVID crisis, we have already seen central banks have taken several steps like emergency policy rate cuts, liquidity infusion into the system by buying safe government securities. Also, in the last few months, we saw central banks purchasing increasingly riskier assets like foreign currencies and mortgage-backed securities to widen the scope of liquidity injection. Although negative interest rates may seem to provide some sort of solution for COVID economic slowdown, as it intends for the banks to lend more and public to borrow more at lower rates. But my question is, why would individuals and businesses borrow more if the economy is gloomy enough to put the principal repayment in jeopardy? When there is no increase in borrowing, it will definitely lead to increase in the cost for the banking system as a whole, as we have seen in the second argument. To cover that cost, the bank will begin to search for riskier assets in order to earn higher returns, which leads to crises such as subprime crisis of 2008. Thanks for watching the video. Hope you guys liked it. Please subscribe the channel and press the bell icon next to it so you don't miss the updates. See you guys in the next one. Thank you.